Breaking news, the Fed raises interest rates by 0.5%. In today's video, we're going to talk about how that impacts the housing market. Hey, what's going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and we have an awesome video here for you today. We're going to take a look at the recent article here from CNBC. There is a short video clip, and then we're going to look at a chart from the St. Louis Fed that shows the difference and the correlation between the Fed funds rate and the 30-year fixed rate mortgages, and we're going to take a look at how that may impact the housing market. Now, if you are new to the channel and you haven't done so already, consider liking, subscribing, and let's get right to it.
Federal Reserve raising the target range for the federal funds rate by 50 basis points to a new target range of 75 basis points to 1 percentage point. The Fed will begin to reduce the balance sheet on June 1. It will ramp up the balance sheet reduction over time. It's going to begin with $47.5 billion in balance sheet reduction through August. And then after that 3-month period, it's going to reduce the balance sheet to allow the runoff of $95 billion a month as expected. And that'll happen beginning in September. That'll be a total of $60 billion in treasuries running off the balance sheet every month, $35 billion in mortgages.
So the Fed intends to reduce the amount of mortgage-backed securities that it's purchasing, which ultimately means that we may see higher rates moving into the future. Because right now, they have been a large buyer on the secondary mortgage market, scooping up a ton of those mortgage-backed securities.
Reserve says household and business spending remains strong. Job gains have been robust. The Russian invasion of Ukraine likely puts upward pressure on inflation and weighs on economic activity. A very quick analysis, guys. There's one sentence in here that was a little more dovish than I expected, and a lot of other observers thought there'd be a line in here about the Fed moving expeditiously towards neutral. It doesn't say that. It just says anticipates ongoing increases will be appropriate.
Okay, so just to recap some of the key points, Federal Reserve increased the rates by 0.5%. The central bank outlined a program in which it will eventually reduce its bond holdings by $95 billion per month. I think that's starting in August. $35 billion of which are going to be mortgage-backed securities. They're going to start buying less and less of those. So the rate move itself is actually the highest rate move that we have seen since the year 2000, and that of course is in response to inflation pressures that we are seeing. Additionally, Jerome Powell underlined that they are still going to stay committed to bringing down inflation, but they indicated that raising rates by 75 basis points at this time is not something that the committee is actively considering. What is going to happen with the housing market, and how will this impact interest rates? And I have a really cool chart that I want to share with you. Obviously, the Fed funds rate doesn't impact mortgage rates directly, but there is a reasonable correlation as seen on this chart right here. So up on the screen here, I have a chart showing the federal funds rate. And you can see the different peaks and valleys over history. What I'm going to do here is edit this chart, and I'm going to add a line. And we're going to add the 30-year fixed rate mortgages in the United States. Go ahead and add that to the chart, and let's see the correlation between the two. So the red line here is the average 30-year fixed mortgage rates, and then the blue line is actually the Fed funds rate. Now, what's interesting is, though, even though there's not a direct correlation, you can see there is a reasonable correlation between the two. If you see the federal funds rate go up, mortgage rates tend to follow. Fed funds rate goes down, mortgage rates tend to follow. So you can see these different peaks and valleys over the last couple of decades here, which I found very interesting. So right here in about 2004, 2005, the Fed started raising their Fed funds rate to try to combat inflation. That was leading into the great financial crisis. You can see that mortgage rates went up a tad, then they pretty much stayed stagnant. And as soon as we came into that great financial crisis here, they dropped the Fed funds rate down to 0, and then mortgage rates started to follow, albeit at a lag. And of course, the same thing happened in 2017, 2018. Once we came into the pandemic in March of 2020, federal funds rate came down to 0, and mortgage rates followed them. So of course, the reason why I'm showing you this chart here is because the Fed seems pretty serious about taming inflation. The cost of goods and services have risen dramatically. The prices of assets has risen dramatically. We've seen stock markets hit all-time highs. We've seen housing hit all-time record highs. And they are stating that the economy is strong. The job market is strong. We've seen a reasonable amount of wage growth. And as a result, they want to go ahead and raise these interest rates to try to cool things down a little bit. So just in the last 4 months alone, we've seen interest rates go from the high 2s up to about the mid 5% range. So basically the rates have nearly doubled from their lows that we saw last year. Now, does that mean that higher mortgage rates will make the market crash? No, not necessarily. However, there is a mathematical equation that we really do need to pay attention to, and that is the actual cost of ownership with these properties. Now, I think a lot of people talk about cash buyers, but in reality, I would say that the bulk of home buyers out there, maybe 70 to 80%, are actually purchasing using a mortgage. So it's a huge factor when they're looking at their monthly budget. Now, if we see elevated prices, we see rates continue to rise, there will be a point where they're going to have to rethink their purchasing decision because it is simply not affordable. So what does all this mean if you are a buyer in this market? Well, if you're looking to purchase a home in this market, and let's say you are a first-time buyer, here are a couple things that I would personally consider. The first is I would take a really good hard look at my current job. I would make sure the income is stable, and if I know that it is stable with a high level of certainty, I would look for opportunities to expand my income there with that current employer. In addition to that, you could look at taking on a side job or side hustle. The idea is you want to increase your income because the cost of goods and services around us has all gone up. The other thing I would dig into is my expenses and just see if there's areas that I can cut to sort of decrease or reduce that monthly budget so that we have more disposable income that we can ultimately save and set aside for a down payment. Now, on the note of down payment, if you don't already have that set aside or saved, I would continue to save for that. In addition to the down payment, I would make sure that you budget for closing costs as well as a financial runway, because inevitably when you go to purchase a home, it always costs more than just the down payment and closing costs to get in. You know, there's moving costs, there's furnishing costs, there's random miscellaneous items that you would never even think of. They come up, and lots of those little things end up nickel and diming you to the point where you're like, you know, this could be hundreds if not thousands of dollars extra just to get into a property. And then, of course, the last thing would be just control your attitude, control your behaviors, try to keep a positive outlook on life, try to go out and do all of the behaviors that will get you the result that you ultimately want. So if you have been offering on properties for the last several months and you've gotten outbid, well, just continue to stay positive and get out there and make more offers on these properties as they come available. Just really hone in your search, define the criteria, understand exactly what you're looking for: square footage, bedrooms, bathrooms, amenities, features, locations. Just really define that criteria, and as those properties come up, make those offers. And eventually that hard work will absolutely 100% pay off, and that is super important to understand. Now, despite having higher interest rates, on the plus side, that's probably gonna slow things down a little bit, so you're gonna see more inventory come online. You can be a lot more selective, and you can probably be a little bit more aggressive in the price and the terms as you're going out there to make some offers. But, you know, just defer to your real estate professional, defer to your lender. They are the ones that are active in your market, and they can help guide you through that process. Anyway, that's all I have for you today. If you haven't done so already, consider liking, subscribing. We'll see you on the next video.